Okay.
I'm not here to market to you, I'm not going to sell stuff to you. I'm just very good speaker. I've got some things I can share via email too.
Yeah, I got an email from.
And you're on screen from behind this table back.
Okay.
So this
Okay.
is your stage.
This is my work area.
Yep.
Okay. I got it.
Okay.
I have to decide which pair of glasses is appropriate to wear, so which ones can I see the best out of? I'm at that in-between stage. I've got trifocals. What I need is quadfocals, the ones that you can see.
Okay, I know, I need to sit closer.
And I was gonna see if they had. Oh, they're not coming here.
Okay. It's chilly this week.
I forgot to ask if they had something I could write on the whiteboard with, but I was just gonna make a list, so. Give it a few more minutes and see if anyone else shows up.
It's probably,
Okay.
yeah.
Okay. Yeah, they might come in, so. So, for those of you who don't know me, I'm Stephanie Matthews. I've been a member of this church since I got here when I was 3 years old. And I have horrible puppies. Yes, that's what everybody knows about. If you follow me on Facebook, you get to hear the stories of my horrible puppies and my crazy chickens. So, and that seems to keep a lot of people quite entertained. But I've been in Wenatchee. We moved here whenever I was about 3 or 4 years old. I grew up in this church, so I've been here forever, it seems like. You know, it's one of those things like I used to laugh and say, well, you know, I tried to quit going, but God kept dragging me back in here. So I've just always been here. This has been my home. I know all the I used to offer to come in and teach the junior high youth group and that, all the trouble things that they could get into that they might not know about, because I am a pro and all the secret places and fun things you can do around here, pew races and all sorts of things like that. But so I've been in the Valley for forever. I've been in mortgage lending, doing home loans actually for 40 years. Yes, I need to retire, but the problem is I still love what I do. I love helping people. I love talking to people. I love math. You know, I've been doing this. I got started in the business with, I was given a position in secondary marketing, which is where normally people come into this business and you start as a processor doing home loans, and then you move up into secondary marketing. Secondary marketing is where was packaging like large bundles of loans. Hi, Francisco. I packaged like huge bundles of loans for Columbia Federal. I don't know if any of you guys remember good old Columbia Federal, and sold them on the secondary market so that we could relend the money. It's something people usually have to build up to, and for some reason they hired me for that job right off the bat. Francisco's gonna fix it for us. Francisco, he's from my office. I work for Guild Mortgage. He's been here with us for about 6 months.
About 6 months?
About 6 months. And he hasn't heard this presentation, and I told him, come on down if you want to learn a little bit about good old reverse mortgages. So, back to a little bit more about me. So I started off in secondary marketing, and I went backwards, and I went from there to compliance, which is auditing and looking at making sure that loan officers are doing their work like they're supposed to do it. And I helped write loan descriptions that had to be done per law and guidelines. I have no idea how I got these jobs, but they gave them to me. And I did that for a while, and then Judy DePew asked me to come down and be her assistant as her loan officer. And I got there, and the second day she goes, okay, good. She goes, I'm gonna go play golf. You've got 2 clients coming in to do loans today. And I'm like, oh, I thought I was an assistant. I didn't know I was going to be the loan officer, but that's what happened. So I was with them and became Washington Mutual, and then I left there. And before they became Chase, before the banking upset thing, I opened up my own shop with Wayne Loringer, who was with this church for quite a while. We had Hearth and Home Mortgage. I did that for 10 years, and then as the mortgage industry changed, I had to join another company, because the smaller companies like that, you had to have your own compliance departments and all this stuff. After 2008, with the financial crisis there, the whole business changed, And all I ever really wanted to be was just a loan officer. I like to talk to people, I like to help people. That's what I do, that's what I'm good at. So, I've done standard mortgages, you know, FHA, USDA, conventional, VA loans. I pretty much know all of those like the back of my hand. Reverse mortgages, uh-oh. It's gonna go to sleep on me. I'll have to sign back, see if it wakes back up. Am I here? Do you see me? Yeah. Reverse mortgages came out in the early 2000s, and I did them for a while. There were some things I didn't like about them at that time. But you'll hear them called, we call them the flex payment mortgage, and there's another one that is, there's all sorts of little short names we're gonna go through here in a few minutes. But let's just start with the elephant in the room. What are the horrible things you've heard about reverse mortgages?
Oh, that you have to have everything repaired before they'll do
Okay.
anything.
That's not quite true.
I've heard that.
Okay, yeah, but they do have, the house does have to meet FHA guidelines. But that's usually little things like, the pop-off valve on your if it's an older home, the hot water tank has to be drained from 4 inches off the ground. It has to be 3/4 of an inch around rather than a half an inch. That's pretty common. If there's repairs to be done on the home, yeah, those are gonna have to be done. They'll usually help you pay for those with the loan too, so. Anything else? Cause I can tell you all the horrible ones I've heard and why I used to think they were horrible. There used to be the belief that, if you got the loan, that meant that there was nothing left for your heirs and for your kids or anything. That bank owned the house whenever you're gone, cause all the equity would be gone. That's false. And then just the basic one that you did this loan and then the bank takes over whenever you're gone, and that's not true. You do have to live in the house while you're using the loan. Some people don't like the fact that there's a variable rate option, which is one where the rate could change annually, and there's a fixed rate option. A lot of people say, well, I want the fixed rate, but you'll understand hopefully through this why that might not be the best thing for you to go with. I used to think, that, your house, well, I still believe, owning dirt has been my best savings account. I've owned rental properties. It's the thing that has appreciated the most, that I've made the most money on. And, most people, their home is probably one of the highest valued items that they own as they get older. And you have to start thinking of your home as being a savings account. And that took me a little bit to get my head wrapped around. But it is one of your best savings accounts. Some people say, well, I don't want to do the reverse mortgage because I want to have something to give to my kids whenever they're gone. Well, if you actually talk to your kids, hopefully their primary concern would be your health, your safety, and your security, and that you're comfortable. I have not, because of the way they do the reverse mortgages now, there's gonna be plenty of equity left to give to your family, to give to your heirs. But there's gonna be a way that you can use that equity to help yourself live more comfortably. There's lots of different ways we can use that. So let's just kind of dive in. Again, I've got the paper going around. I'm not gonna put you on a mailing list or anything. You might get an email from me thanking you for being here because that's a socially acceptable thing to do. But other than that, I'm not gonna bombard you or anything like that unless you want more information. I'm gonna give you a way to reach out to me. I will tell you right off the bat, reverse mortgages are not my specialty, okay? Guild, one of the things I love about my company I work for, and there's lots of things I love about them, they bought a company that does reverse mortgages. So we retain the servicing, and what that means to you is that at this time, you would be making payments, if you were making payments, inquiries or anything like that about any mortgage you get through us, 90% of the time, you're gonna be dealing with Guild to do that. And the other thing is that the servicing, because on these reverse mortgages, sometimes there's questions as you go along. Can I get some more money? How much more money could I get? I just need $5,000 right now to pay my taxes or whatever it is, or I need a new roof. You call and talk to somebody who's affiliated with the program. So that's that I really, really like. And we have a reputation for being one of the best servicers in the nation for our mortgage. And the servicer is the person who you're making your payments to, who you call when you have good things or bad things happen, okay? So that's one of the things I really like about the program. And the other one is that they have a whole department that just specializes in reverse mortgages and training and talking to people about them. I have a friend who was working with us for a long time. I call him my darling David, but he was David Darling was actually his name. And he was actually going to do this presentation for me over video. I mean, he was gonna just dial in and go through it with this because he's really good at this, and this is what he talks to clients about all the time. His wife got ill, he had to take a sudden retirement, and he's not able to be here, so you get me, okay? And so I'm gonna kind of fumble my way through it and tell you what I know and explain. I mean, I had a recording of his presentation whenever he did it, so I'm pretty familiar with it, but if you have questions, I'll make sure they get answered. And if you want to talk to a true expert, there's no charge. I will connect you and you can learn anything you want to do. I've been on the phone with them for the last 2 weeks, making sure I understood what I needed to know, so. Okay, here we go. So it's called the Flex Payment Mortgage. It's the reverse mortgage program. I don't know if I'm still on the camera or not, but I'm not gonna worry about that. So
Yeah,
it's,
going.
oh good, okay. And then I should have brought a mouse, but I didn't. Okay, now I'll get to do all of this stuff, because every time, where did that go? Where did that come from? Francisco, what happened? Where did this appear from?
There.
Oh, here we go. There's the X. Okay. Reverse mortgages is what I still call them. They're trying to train me to call them the flex mortgage because you have a flexible payment option on them. But it's an FHA insured loan that allows you as a homeowner to convert any equity in your home into available cash. And that cash you can use for anything. We prefer it be legal, but you can use it for vacation, you can use it for improvements to the home, you could use it for helping a grandkid or child get through college, you could use it to take your whole family on a cruise, you can use the money for anything you want, anytime you want, okay? They also are called a HECM, a home equity conversion mortgage, is another type of a flex mortgage. The FHA insured ones are the ones that we do. There is a conventional one that you can do. FHA insured means that it's insured by the federal government. And I like these the best because even though they're a little bit more expensive, there's no recourse on them, and I'm going to tell you what that is here in a few minutes. So I get a little bit ahead of myself doing this, but to be eligible for this loan, you have to be at least 62 years of age at the time of closing. You have to own a home and you have to remain in the home for the duration of the loan. If you move out of the home, then the loan is technically due. We'll talk about what happens then. You have to be current on all your property taxes and insurance. If you're not, they're going to use part of the funds from this loan to get you current on those things, because we don't want the county to come back and place a lien before our lien and we are no longer in first lien position. We don't want, there's a fire, you no longer have a home and we no longer have anything to secure the loan with. So we want to make sure you keep your insurance on there. You get your homeowner's insurance through whoever you choose. We're not going to assign that to you. It just has to be someone who can insure in the state of Washington. Here's the part I like the best. So today you're listening to me chit-chat about these reverse mortgages. They also require that you do HUD counseling with a trained HUD counselor who is a disinterested third party. They don't work for Guild. They don't talk to me. Some of them will talk to me. Some of them have allowed me to sit in on their counseling sessions, but I'm just not allowed to input anything. The reason for that is they want to make sure that you're not being influenced or pressured into doing this kind of a loan. It has to be totally your decision, and we want you to understand it, so you're gonna listen to information on it several times to make sure you understand the program. The other thing is that if you have family members, your kids, siblings, or someone who's concerned about you doing this, I encourage them to sit in on these counseling sessions and sit in on the ones that you're gonna talk to the guild person, also the employee from guild, because they can ask questions. They don't want you to make a bad decision either. So we wanna be sure everybody understands the program and what you're doing, okay? And we talked a little bit about the house has to be approved property according to FHA standards. Typically, the only thing that's gonna become a real problem from FHA is if your house is not on a permanent foundation. If it's a manufactured home that's in a park or on leased land, that's not something we can do a loan on. It has to have running water, power, electricity. We don't do off-the-grid loans with these mortgages, with pretty much any mortgage, actually. There might be, if there's things that need to be done to the house for safety or to bring it up to code, in some instances you might be required to do those things, but they're things that need to be done anyway for when you go to sell the house. If you need a new roof, you can use the funds from this to put a new roof on the house. If you need it painted inside and out, which is not something FHA would normally require unless the appraiser gets there and there's chipped and peeled painting all over the house. And they might say, yeah, you need to get some paint on this because you're gonna get wood rot. Otherwise, they're not gonna require that. If there's wood to earth contact, which is where your earth is pushed up against the house, or like you might have your firewood stacked right up against the house, that's considered wood to earth contact. That is a great opportunity for pests and bugs to get into your woodwork, and they might require that you move that back. And if there's evidence of pests inside the house, what do they call the little bugs that come up out of the ground?
Termites.
Yeah, termites. We used to have a real problem with that in this valley because everything here is built on orchard land, but now we never see it. We used to have to have a pest inspection done. It seemed like on every house it was required. Now they will usually do them, but typically it's not gonna be required unless there's evidence of termite infestation. Wake up. I know, here I am. I'm still here. There we go. Okay, so they're gonna send an appraiser out who's going to establish the fair market value of your house. You will get a copy of that appraisal. It'll give you a good idea of what your home is currently worth. As I like to say, but your house is worth as much as somebody's gonna pay to buy it, so keep that into consideration too. And then okay. What this program does is it allows you to age in place. That means that you can stay in your home. Now, if you go south for 2 or 3 months every winter, you're still fine. If you want to go south every 2 or 3 months, this might be the way to help you financially be able to do that. But you've got to remain in the home until you move out or pass away. At the time that you move out of the home or the time that you pass away, there's going to be a full 12 months before the loan will be called in. So you have lots of opportunity to go through the process to either sell the home, have family inherit it, and put the financing in their name for different things like that. Okay. This is one of the best things. No house payments. So if you currently have a house payment on your home, you're not going to have one anymore. If you want to make the house payment, you could. Let's say you owe $200,000 on your home. Maybe you just want to pay the interest. You could just pay the interest. Or if you wanted to make a full payment, whenever we do the loan for you, the first thing we're going to do is pay off any existing mortgages or liens against the home, okay? And those are going to start accruing interest, but there's not a payment due, okay? And you've got to stay current, like we talked about earlier, on the property taxes, your homeowner's insurance, any HOA dues. These are not driven by credit scores. And they'll talk about that in a second. The different ways that you can access the funds on this line of credit. So let's say that how they determine how much you're qualified for is they look at the current interest rates. They look at your age, they look at the value of the home, and you're gonna be able to finance a percentage of that value of the home, okay? So if the house is worth $500,000 and you're at a certain age and they say, okay, you could borrow up to $290,000 and you owe $50,000, so now you've got $240,000 in that line of credit that you can use as you choose, okay? So the way you could access that additional money, that line of credit that's available, you could just take a draw from it as you needed. You would call whenever you need money and take $4,000, $5,000, whatever you needed. You could set it up to receive a set amount each month. So say, okay, I'm gonna remain in the house for 15 years and my Social Security is $2,000 a month and I need another $1,500 to live comfortably. So I'm gonna pull $1,500 a month out of this for 15 years. And they'll do the math and make sure that that's not gonna put you over the line of credit that's available, the whole amount that's available to you, and you'll just get those checks automatically. You could set it up for tenure, which says, okay, I've got 30 years on this loan or whatever the life of the loan is, and I want to receive equal monthly payments from my line of credit, and they will calculate that out and tell you, okay, this is how much you're gonna get every month to live on. You could take the whole thing, one big lump sum, and invest it and do whatever you chose to do with it. You can do any combination of those, okay? Maybe you wanna take X amount a month, be able to call whenever you want more money. You can change your decision throughout the life of the loan, how you want to be paid. And each time you make that change, there is a $20 fee, but it's wide open on how you access the funds. And you would just call your servicing department and tell them, this is what I want to do now. Whenever I need $5,000 right now, I need $10,000 because I need to put a roof on the house or whatever you need. And they will facilitate that for you as long as there's still the funds there to do that, okay? So we know we can change that as we go along, and that we've got lots of options on it. Whoops, I think I missed a page. I'm gonna go back up here somewhere. Nope. No. I knew I should have brought a mouse. Oh well. Oh. The other thing you can do is, the theory used to be that people took this reverse mortgage as a last resort, okay? They didn't want to go into care or they needed some extra money, but they would go through all of their savings and investment first and then dive in and set up a reverse mortgage and take funds from it. You don't have to take money from it. You could just set it up and have it sitting there for down the road. And the reason for doing that is in case of an emergency or in case you just need to do lump sums for vacation or something like that. But about 2012, 2010, in that era, financial planners started looking at this and going, well, you know, there's a way we could make this work using this reverse mortgage along with your investments, and maybe we could actually be making money for you. And that's what this is. So that's where we're gonna go with the next one. Okay. This is where the math gets interesting, okay? And I don't know how well you can see this, but the first original conventional thinking was that you would go into your savings account. You had this uses a starting date of 1973. You had $500,000 in investments, and if you were taking, and it doesn't tell me what the amount is here, but here it starts out at $27,500 a month, so $27,500 divided by 12 is a little over $2,000 a month. So, and then if it increases because of the cost of living, so we end up having to take a little bit more. It says that in 1996, they went through all of their savings, okay? So they started out with $500,000. During that time frame, in the red is where their investment for that year as a total actually lost money, and the black is where it made money, okay? So they've gone to 1996, they're out of money, so now they're gonna start drawing on their line of credit. So we start off with $36.61, this takes us down to 2002, so that's how many years? 2002 to 1973, 83, 93, 2000, yeah, so that's over 30 years, okay? So, in 1996, they started taking draws on their line of credit, okay? This is what that money could have been earning, okay? So they're out of money here. They take their draws until 2002 and it's time to move on. They owe $538,000. That's how much is owed on the home, and by that time, in this instance, they were starting off with a home that was worth $500,000. The house, based on appreciation history over 40 years, probably would have been worth close to $1 million, believe it or not. So they would sell your house, pay that off, and anything above that that was owing would go to your heirs. The chances of you, looking at the long-term history of these, the chances of you ever owing more than what the house is worth is very, very, very minimal, because they're pretty conservative in how much money they're gonna loan you. So they came up with this idea, another idea of how to use the line of credit. So they said you start off with your $500,000, and at the end of each year, you look, did my investment value go up or down? So you start off with $500,000, you're taking your little over $2,000 a month, and that first year, your investment value went down, your return on your investment went down. So that next year, you're gonna start take money from your flex mortgage and give this a chance to recover, your savings to recover. So it went down for 2 years, and then it started going up again, so we started going back and taking money from our investments. So they went back and forth like this, and what happened in that same time frame is, yes, at the end of the 30 years, they owed $692,000 on their home, and now it's worth $1 million. But there was over $1 million in their investment because you weren't taking off that principal. You were able to keep that money growing, because whenever you sell a stock, it's gone. But if the stock price is down, or you want to move it to something else, you get a chance to reinvest and use that money. It's an interesting concept. I'll be honest, it's a concept I'm going to use, because I will do a reverse mortgage. I'm trying to wait till I'm 65 to set it up, or until rates get better. Right now they're a little high. So anyway, they ended up with $395,000 net there, plus the house is free and clear. So they've got a house that, that's worth, somewhere between $750,000 and $1 million at least, that's free and clear for the heirs and for the family. So that's one idea of how to use it. The next idea, if you look at your reverse mortgage compared to your CD. So this is in 2024, January. So you had $90,000 in a CD at 2.5%, and in 15 years, that CD is gonna be worth about $131,000. The flex mortgage line of credit, if you had credit available to you of $100,000, and the credit line increases as you get older and as the interest rates change. So they're saying in that 15 years, you would have had $268,000 available in equity out of your house in that 15-year period. So that's kind of a nice return on your money. So you're looking and you're actually getting a better return here than you are on your CD. I'm not going to defend all these thoughts, I'm just presenting them to you and how financial planners are looking at them, okay? And here, they decided, okay, we've got that $90,000 in our CD account, we've got our reverse mortgage set up, and we've got $100,221 there. So now that CD is gonna earn 2.5 over 15 years, we know it's worth $131. On this line of credit, because it's increasing, we've now got, it's a little higher rate, it's based on the more current rates. So you've got $297, $254 available. So what if you just drop that CD down to $10,000, paid off anything that was owing on that home equity line of credit? So say you owed $200,000 and you paid $80,000 on it, now you've got $180 available on the line of credit. In 15 years, you've got $535,000 available. And again, a good counselor is gonna be able to explain this in much more detail to you, but the math does make sense on it whenever you look at it. And in 15 years on your CD, $10,000 CD, you've got 15,000 there. So you've got a little bit more money to spend. This shows the gray line here is your loan balance. So this assumes that you started out owing $200,000 on your mortgage, and that your line of credit was this amount, and it was going up it's going up throughout the life of the loan. And then this is the remaining equity in the home that's still there to be used. Okay, so it shows, the history on these show that they're set up so that you're never gonna owe more on the house, that you should never owe more on the house than what it's worth based on the history of appreciation of real estate. Here's another way to use this, is to delay taking your Social Security. A Social Security is available at 62, and in this hypothetical example, you get $1,200 a month. At 70, you could get $2,153 a month, and your annual COLA is running about 2%. So you want to defer your Social Security. You choose, you want to defer your Social Security until 70. So you're going to take your start taking your, here we've got the Social Security. So you're not taking any Social Security until you reach that 60, sit to that age of 70, is what your Social Security would have started. If you started it out at 62, you would have ended up by 1990, or by the time you're 92, you would have taken about $650,000. If you waited to your 70 to take your Social Security, you would end up taking closer to about, and I think it runs out to be about $790,000. So what it's saying here to do is to take the draws from your line of credit until you're 72, and then start your Social Security so you're getting the higher amount, and then you can reduce how much you're taking off of your equity loan or out of your other investments, okay? Again, it's math, somebody's gonna explain it to you, and I'm going to go over again that we've got really good people who can explain this better than I do, and you're also gonna talk to your financial advisor about it. But there's a lot of ways that you can use that equity in your house to live more comfortably. So some of the ideas they've come up with is they said exploring your legacy options. Giving while living, to witness the benefits of your inheritance on your heirs. Maybe you want to help someone pay for college. Maybe you want to start taking an annual vacation with your family. Maybe you want to help somebody buy their home. Maybe you want to pay off someone's student loans so they can just live a little more comfortably. Maybe your alma mater at college, from where you went to school at, you want to leave some money and see how it goes to work and have them throw you a big fancy dinner or something like that, okay? You can travel. You can go places that maybe you wouldn't feel like you could normally do because you just don't make enough off of your retirement and Social Security. You can enjoy more time with your family. It's just, like we said, we don't care what you use the money for as long as it's legal. And believe it or not, that's actually in the deed of trust. So on the property that it says that. So there's lots of ways to think about doing this. While you're still alive, you can see your family enjoying these experiences with you or with friends, or it just makes your life a bit more comfortable. There we go. You could also use this reverse mortgage, flex mortgage payment to maybe sell your existing home and buy a new home, okay? Maybe your home is on 3 floors, it's way too big for you. It needs a lot of maintenance and upkeep that you're just not up to doing. You're sick and tired of doing lawn work. Although if you had this, you could budget to have somebody come in and do your lawn work and house repairs for you. But let's just say you decided you want to live in $1 million house, okay? And you would have to like vacuuming a lot for it to live in, that's my opinion. So you could buy the new house with less money down compared to using all of your cash from the sale of your house to buy a new home. You could take liquid assets compared to paying all cash for everything. So you could leave some money behind that you could live on and use for other things. There's no payments required on this, remember, on this loan, if you borrow money on it. There are very limited income and credit qualifications. They just want to know what your income sources are, and whenever they look at your credit, they're looking at, do they just make their payments on time? If there are collections, past bankruptcies or anything like that, they might require that you do include the taxes and insurance in your payment. Otherwise, they're just gonna have you pay them yourself. But they're not looking at credit scores. They're just gonna try to make sure that you can manage your credit correctly. And you have the security of owning a home versus renting. I have an instance in my family where my aunt has a lovely home, and it's not super big, and I really thought that she would want to stay in it. She's decided to sell it, but she's discovering that she's gonna sell it, and she's gonna have $300,000 and $400,000 to live on, but she's gonna be paying rent at $1,800 to $2,400 a month to live in something similar. And that doesn't include, like if she needs to go, what if she needed additional help around the house or something? So if you do the reverse mortgage, you own your home, you're gonna have funds that if you needed help around the house, you needed someone to help you come in and clean once a month or once a week or twice a week like I do. Or if you needed help with gardening or putting up your Christmas lights, you're gonna be able to do things like that comfortably, not have to do it yourself. And that's gonna be a lot less expensive than living in a retirement home. I know that with my mom, and she passed away last year, but her care was running us $7,500 a month. Because by the time we had somebody coming in, preparing meals for her, and this was living in a care facility with a group. It was a lovely place, but she needed someone with her mental health, with her dementia issues. She needed someone who could prepare meals for her, help her with her pills. She could bathe and clean up, but just make sure she was, and plus she was living with a group of people, which she really liked. But we kept her at home for as long as we absolutely could. We didn't need to have a reverse mortgage at that time. She moved in with my sister, but I think anybody would agree that it's better to be in your own home than moving into an apartment. So, but it's a choice, okay? On this program, again, there are fixed and adjustable rate mortgage options on the payments. I'm gonna cover that here in just a little bit. So here's a conventional strategy. Your house is worth $700,000, you don't owe anything on it. It costs you $56,000 to sell. That's your excise tax, title, settlement fees, recording fees. Maybe you probably had to pay some money towards the buyer's closing costs. So you've got proceeds of about $644,000. With your new home, I'm gonna take a sip of water here, I'm talking too much. So you've decided to buy that $1 million loan, $1 million house. And for the flex mortgage, you're qualified for $409,000. And again, this is based on your age, market rates at that time, and the value of the house, okay? And it's gonna cost $33,000 in closing costs to do the reverse mortgage. And yes, those costs seem high, but remember, we're gonna talk about the loan, you can't ever owe more on the loan than what the house is worth. So you're getting $376,000 available. So you've got $376,000. So you're putting in $624,000. You bought the house for $1 million. You don't have any house payments, and you've got $20,000 left over. Okay, so that's one way. No house payments, and now you're living in $1 million house, and you're going to get a lot of exercise vacuuming that house because it's going to be a big one. Okay.
Get your 10,000 steps.
Yeah, you'll get your 10,000 steps in. Another one is to downsize. So you've got a purchase price of $500,000. You were approved for $205,000. You've got $21,000 in closing costs. You've got from the flex payment, you've got $184,000 line of credit remaining. You've got to put in $316,000 of your of your own money, living in a $500,000 house, and you've still got $328,000 in the bank. So there's ways you can do this where you can downsize or move and use it for the purchase of a new home, okay? Next page. You can refinance it that originally started, the program was used to refinance an existing mortgage so that you just don't have a house payment anymore. And you have access to the equity in the future to use as you please. The big thing is you get to stay in your house with a little bit of peace of mind. So if we retire your existing mortgage, and I keep looking over here. So your property, this is your property value. You owe $200,000 on your home. So you're using $222,000 with closing costs, and there's all that to do to set up the mortgage. We pay off the $200,000. You've got cash at closing of $22,000 coming back to you. Plus, you've got this home equity. The line of credit amount is growing on top of this. So as you may only have $20,000 now to use that you could draw against, but as you get older, it's going to increase because you'll have more equity in the house. They're based on your age and how much equity you have in the house.
Stephanie, I have a question. On these payments, in lieu of you paying mortgage and maybe you say you're taking a monthly stipend, how is that income treated for income tax purposes?
It's not taxable.
None taxable.
Yeah, that's part of
That's
what we're
nice
getting
to
to.
know.
Yeah, it's not taxable.
And I also want to know, is a condo covered? You said something about manufactured homes.
Yes, there are some condos that are real easy to do. Some condos, we can do them, they have to have a one-time FHA approval on it, and that will take a little bit of help from your board of directors. I do know that there is one condo project over in East Wenatchee that we've gone to and they've said, nope, we won't do it. We don't want FHA mortgages in here. Well, I'm trying to set up some time to go and talk to them, help them understand, because it's gonna help people stay in their homes rather than moving on. But most of the time, we just have to get the info from the homeowners association, make sure it's okay with their bylaws that you can mortgage the house, and we can do something for you. We can do the homework on that for you. So if you own the home free and clear, you've got $600,000 in ballot and value. At age 70, you can get you've got a line of credit now that's worth $222,000. You pull out $75,000, and you take $75,000 at closing, so you've got $147,000 in equity. That will continue to grow as you grow older and are living in that house. And again, we remember there's 5 different ways that you can take that. You can take a lump sum, a monthly amount. You can have them amortize it out over a period of time. You can do it over tenure. But anyway, so this goes from 2024 to where you'd be in 2039. You would have a loan balance if you took that $75,000 here of about $100,000, and you've got the house is appreciated now, and you've got that much in equity. So the bank doesn't want your house back. They want to make sure that there's plenty of equity there whenever you're ready to move on and sell the house. Okay. The line of credit growth. Okay, so this is just another example. 62-year-old borrower owns a home appraised at $500,000. The initial line of credit is $168,206. The line of credit is going to grow, and that's if you're at a rate of 5%, you would have up to $400,000 available by the time you're 80. Okay, if it grew at 4%, I think this is the one, you're going to be at about what, 325, 350. My vision isn't that good in these glasses. But because the rate changes, that affects, with the combination of your age, that's how the funds grow for you. This shows where you would want to consider the adjustable rate over the fixed rate. Because the fixed rate, the only way that that line grows is if you refinance it. But with the adjustable rate, it changes with the market conditions, okay? We have not seen depreciated value in this valley. Even in 2008, our depreciation rate was lower than the entire nation, what we saw. It's always been appreciated. Now, we don't appreciate as fast as Seattle or the big cities, but we're much more stable. And right now, our average is running 4% per year in appreciation and has been for, I think, the last 10 years or so. So we're, well, except for 2008, we had the crash, but dirt's always been a good investment. It does grow. So, how to get the mortgage? You're gonna start off, I need your W-2s, pay stubs, 1099s, verify what your income. We're gonna look at your credit. We're gonna do the FHA appraisal. Then we're gonna determine, do you want the reserve account, or do you wanna pay your own taxes and insurance, or is there a reason that might be required for you? So it's minimal, it's time consuming, so we've gotta wait for the appraisal and classes. So you've got to do your HUD class, you're going to talk with the guild people several times. We'll get them in on the documentation. Usually runs about 45 to 60 days, okay? I've had them go faster because people just, I don't know what happened. I guess it was slow and somebody just got things done a little quicker. Right now, appraisals are probably the things we're waiting the longest for. It used to be we would be waiting 2 or 3 weeks. We're down to about 10 days waiting for an appraisal. So, what happens when the loan comes due? Typically, the loan's gonna be repaid whenever you sell the house, okay? If the house is more than the loan balance, the estate retains the funds. We don't take anything, we just pay out the loan and wish you well, okay? If your heirs wanna say that they decide that we wanna take over this house, okay, we wanna live here, they're gonna have an option to do so by repaying the loan at the lesser of the loan balance or 95% of the appraised home value. So that's where the non-recourse comes in. If your home, let's say that you owe $300,000 on it, and it's only worth $295,000, okay? We know the appraisal's coming in low. So your heirs could buy that for 95% of $295,000, so that you have enough to cover all of your closing costs and everything. They're not gonna come after your estate for anything that's owing on this mortgage, and I really like that piece of it. Your family's not gonna be stuck paying anything on the mortgage, it's just gonna be gone. So that's what a non-recourse loan is. The borrower or the estate will never repay more than the loan balance or the value of the home, whichever is less, okay? I have an instance where in our family, we had a family member who did the reverse mortgage, and it was determined that they needed to go into a care facility. They just weren't able to live in the home anymore. They needed more help than they could. They were living quite a ways outside of town, blah, blah, blah. So they called, they said, well, we've got this reverse mortgage, we have to pay it off, we have to sell the house. Do we have to do that before we can move out? I said, no. I said, figure out what your costs are gonna be in the nursing home, take a one-time draw, add a couple months, for a year, take a one-time draw or draw out all the equity you can, put that to one side, move into your care facility, and from that date, you have 12 months to sell that house. And, you have 6 months and then you can get it renewed again for another 6 months. And that way they were able to go immediately to where they needed to be and be in a safer environment. So, not a bad deal. Oh, this page. At the end of the reverse loan term, some or all of the properties equity won't belong to the borrower. They need to sell or transfer the property to repay the proceeds of the reverse mortgage. Your family members could actually even come in and refinance put their home, you could sell it to them for X amount, whatever's owed on the loan, plus whatever the closing costs would be for them to finance. They could get the financing in their name, pay the loan off that way. if you didn't need any equity out of that for your care wherever you're going to, okay? So, blah, 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 if you don't pay your we have to pay property taxes and any back taxes that we're due, so. Why choose a flex payment mortgage? So you can access cash, pay off your current mortgage, not have a house payment. Receive monthly payments if you needed to. You have reserves for the future or down the road that you could access. Use it as part of your retirement plan, which is what I'm doing. Improve your yields. If you're, like we talked about, if your investments are losing money, rather than selling stocks so that you could pay yourself, take money from that reverse mortgage and let the stock's value go back up again. You could purchase a home with the program.
Question.
Mm-hmm.
In your example, ago, you said somebody went to a nursing home or whatever, they had a year to sell the house.
Uh-huh.
What happens if the house didn't sell in that year?
Technically the loan is due and it could be, you would have to give it to the bank. But you have to understand too that in their instance, their house is on the market, I'm just gonna throw a number out at $550,000. Their reverse mortgage, because of the way it's set up, based on age, they owed $230,000. They could drop that price to $400,000, to $300,000, and be able to sell that house. There would not be a good reason for there to have to go to foreclosure, because you could get out from underneath the mortgage. You could get what equity you could out of it. And in their instance, I knew they had it a little overpriced, and they did end up going through 6 or 8 months to sell it, and they finally dropped the price a little bit, and it sold right away, so. But you're gonna have enough equity in it that you're not gonna have to get top dollar for it. Or if you do have to get top dollar for it, you're gonna price it at where it's appraised at, where it's going to sell at, and they're gonna get enough to cover 95% of the mortgage, and it's done. They're not coming after your heirs, they're not coming after your estate for it. I don't want you to have to go to foreclosure, but that would be the other way, is just to walk away from it. But there shouldn't be a need to do that. Okay? Why use Guild from it? This is, you get deep expertise. You get somebody who knows these even much better than I do, who can really walk you through and answer a lot of those kinds of questions for you. Local support, you're gonna meet somebody locally, you're gonna do phone conversations. The people, I've got 2 people out of Denver now that I just are almost my darling Davids, as I like to call them. And our whole goal is to have long-term relationships. So we want to help you now. We want you to send your kids to us, your grandkids to us. So that's why our customer service is so good on this. And I think that's that one. And then I want to go over here, because this is one I've actually, and I'm not going to go quite as deep into this one. Make sure I've got the right one. Okay. This one, I'm going to hand out my handout on.
Stephanie, you did say this is a national program.
Oh, yeah.
Okay.
Yeah.
So every
And
state
this
has to follow the same rules.
It's FHA insured. You got to follow FHA guidelines on it.
Right.
And here's the other thing is that what David used to say as part of his loan, he goes, the reason I want to talk to you and do the presentation, he goes, is I want to make sure that you're not trying to call Tom Selleck to get your reverse mortgage. Because you're going to spend a lot of wheels and waste a lot of time doing that. So this is kind of the package that they hand out or send you email whenever you start talking to a rep on it. And I'm gonna try to not waste, how much time have we got here? A little, not very much more, just a little bit more time. Quick review, no monthly payments unless you move, you sell, or you pass away. In 2021, the housing wealth was surpassed $10 trillion, all sorts of fancy number there. If you want to make payments, you can. You know, and I might decide that I might decide to just take some money, but just pay interest on that money for a while, because I still have a balance owing on my mortgage. Maybe I'll just pay the interest so that that's not compounding. There's lots of ways you can do it. If you want to make a payment, you can. If you don't need to. There's a lot of safeguards built into this. It's insured by the government. You're required to have government counseling from somebody who's not trying to sell you something. And I'm really not trying to sell you something, I'm just trying to educate you and make you think of questions you want to know about this program. The government regulates the cost and the fees, so no matter if you get the loan through me or another lender, the cost and fees are gonna be the exact same, okay? They have the protections against predatory lending by doing the HUD counseling, and it's a non-recourse loan. We can't go after your estate for any additional funds if the house is worth less than what you owe at the time that you go to sell the house. And people have been really happy with it. I mean, people who do this are very pleased with it. The HUD counseling, they'll give you a list of people that you can go to. I don't have any preference. I haven't found anyone who's one better than the other. They're gonna help to ensure that you understand the program, answer questions, and again, I encourage you to tell your family what you're thinking about doing so that they can be part of this education process too, so that they're not worried about the decisions that you're making. The counseling session takes about 45 minutes. I think it costs about $50. It can be done over the phone or face-to-face. You can have somebody come to your home to do it, or you can do it over the phone with someone, or anymore, everybody does everything over the computer with a video camera, it seems like, okay? The counseling is one of the very first steps. I mean, once you've applied for the loan, we know how much you're qualified for. That's the next step, is you have to do that counseling. We're not gonna spend the money, a dime, on title insurance, on the appraisal, setting up as anything. We're not doing anything till you get through that counseling session. So we wanna be sure that you're happy with the decision you're considering. Counseling certificates are good for 180 days, so 6 months. Determining the loan amount is based on the appraisal, the age of the youngest borrower, and the current interest rates, okay? Again, you'll have this, you can make notes whenever you have questions to ask, if you wanna do there. Important facts, it has to be your primary residence. We're gonna pay off any existing liens, judgments, or anything like that, loans. You have to keep the property taxes, keep the home paid, the home insured with your own homeowner's insurance, and any HOA dues have to be kept current. At this time, and I should have said this, manufactured homes are not eligible if it's a manufactured home on private land. There's some places, I think, where you can get them manufactured home on land, but I don't think our program allows for that yet. Our investors aren't doing that one yet. And there's very limited income and qualifying guidelines on this, basically based on age. So here's, and I can't remember what interest rates they used here. If you start out with a conventional loan, you could get, in most anything is loan to value, usually 60 to 80%. On a purchase, you can get in for as little as 5% down. You can, any occupancy required has to be owner occupied. You own 100% of the home. So you can see that this is pretty much everything is the same. But here the HELOC is good for 18 years and you've got payments to make. On your conventional mortgage, you've got payments that have to be made. This one, the payments are optional. These HELOC and the income and the flex mortgage, there are credit qualifications for all of the programs, but they're much easier on the home equity loan. Non-recourse access to insured funds, yes, you have access to those funds. On these loans, you get a fixed amount and that's it. It's not changing over the life, it's not increasing, that line of credit isn't increasing. Owner liability, these are non-recourse, so that, again, that means that if the house is worth less than what's owed on it, we can't come after you for any more, for your estate, for any additional funds that are owed. These, there is recourse. Whenever you go to sell the home, move on, whatever you're gonna do, the loan does have to be paid in full, one way or another. All of them have to have homeowner's insurance. They all have an insurance obligation. Closing costs, and that kind of gives you an idea. The closing costs on these are quite a bit higher than on a conventional loan, but that's because there's no recourse on them. A lot of that is insurance you're paying for to make sure that there's nothing coming out of your estate in the future. We talked, this one is about that line of credit, that it's growing as you age. And you're not paying any interest rate or fees as on anything on that line of credit that's not used. It's just there, you're only paying interest on what you owe. So maybe you don't need the line of credit for now. Maybe when you're ready to move on, you've got to put a new roof on, fix a patio. You've got lots of expenses to get that house ready to sell. My last rental, I put $40,000 into getting that thing ready to sell. So, you know, you would have the funds to do that without diving into your own money, So if you might not need the money up front, you might need it down the road. This is where it goes into the fixed rate options and the interest rate options. This is tied to the 1-year CMT index. This is from 2006 to 2001, what that index has done. The fixed rate is fixed. It's not going anywhere, and it's gonna be higher than the adjustable rate is, majority of the time. This is the one time that the fixed rate was lower, and that's because there was that bleep from 2006 till the early 2007 in interest rates where the index went up. But on this one, on the fixed rate, there's no line of credit to increase. On the variable, that line of credit increases because it's based on what the index and margin are doing and on your age. So, and they'll go over this in much more detail with you mathematically on why you would want the adjustable over the fixed rate. We have the option of the fixed, and we talked a little bit, several times about the how you access the money. You're responsible to keep your taxes current, maintain the fire insurance, keep the home in good condition. You must live in it as your primary residence. If the house needs repairing, you may be able to complete those before closing. If the FHA appraisal required repairs, you could get those done before closing. And we could and they'll allow you to use the funds out of the equity to do that in most cases. So, and I don't see that many repairs coming back. The things that I see most of the time are the hot water pop-out valve, the carbon monoxide, and everybody should have this in their house anyway, the carbon monoxide detector, and what's the other one that I see all the time? Hot water, and the drain thing on hot water tank is 1/2 inch rather than the 3/4 inch it's retired. This is just kind of a graph that goes over how your equity grows. And this goes through all the benefits again. And then it kind of gives the steps of what you're gonna do to get started. So I've got another little handout that briefly summarizes what I just spent over an hour yakking at you about. Does anybody have any more questions at this time? If I can't answer them, I'm gonna give an answer and get back to you. Right
One of the misconceptions is that when I talked to my sister, for instance, about getting a reverse mortgage, she said, well, she wanted to leave the property to her son. And without a reverse mortgage, she couldn't do that.
No,
that was her
not.
misconception.
Yeah, that's a misunderstanding. And the good news is, before you have to pay to speak to a HUD counselor on this, I'm gonna connect you with one of the guild people who can go over and answer any questions you have much better than I can, okay? Because they talk about these things all the time. And that doesn't cost a dime. And like I said, I usually force the people who talk to me about it, I said, I want at least one of your children on the phone with you to make sure, or one other family member, so that they can get all of their worries and concerns answered, rather than you having to give the information to them second or third hand. And it doesn't cost a dime to talk to them. They're great. All that I'm gonna need from you is your name, name, birthday, and property address. And they can kind of look and what you assume the house is worth. If you don't know what the house is worth or don't have a clue, The county tax records is not your best source because it's usually low, thank heavens, because it keeps your taxes lower. But you can go to Zillow, or I can give you the address, I can go to Zillow and tell you what they think your house is worth. I usually go check Zillow, Reddick, and there's 2 or 3 places I go and just kind of do an average. Also, on my, if you wanted to, I can send you an email and you can actually get monthly an update on what they think the value of your house is, how much you owe on it. You know, you plug in your information and it'll sell, and monthly you'll get a little report on how much equity you have in your house. It doesn't cost a dime. That's the one where you're going to see my face pop across your computer once a month at least. So that's
How much
kind
time does it usually take to get your first mortgage?
you know, 45 days is what we tell, 45 to 60, but I've had them happen faster. But I just think they're a good idea. I'm gonna do one. I'm waiting a little bit just because I would like to be just a little bit older, because I'll be getting, the only thing I want to get older for is so that I can get a little bit more equity out of my house available up front. But, you know, I'm excited about the thought of, you know, my Social Security will probably be $2,900 a month. I've got investments I could live off of, but getting rid of that house payment is gonna be huge. And I will still have, even with what I owe, I still have plenty of equity in my house whenever I pass on.
If you have to pay for it, is it?
Yeah, then you
still
just,
something-
then you can just get the line of credit and use that money to supplement your Social Security or other retirement sources. So you could buy a motorhome and travel. So you could,
You don't want me on the road.
yeah, so that you could join travel groups and go to Europe or travel around the world with other travel groups. It just gives you a way to do the things that you've always wanted to do, because the cost of living is not inexpensive. And so it's just a way to access one of your biggest assets, is the equity in your home. So do I have everybody completely confused and baffled?
Is there an upper age limit where you can't apply?
No. Well, I think they assume that, I mean,
You have to be 62, but.
yeah, no,
what
there's
about
no
the other
top,
way?
you need to be alive, but you can.
Alive and living in your home.
Yeah.
They don't cut you off at 80 or.
No. Once it's set up, you've got it. They're not gonna come back and say, no, we're taking your loan away from you now. FHA doesn't allow that. We can't discriminate on age, sex, marital status, or ethnicity. And the test they make me go through to make sure I don't do that is the weirdest test you'll ever have to complete in your lives. Okay, I think you're all ready to go. If you have questions, or if you want to call me, just come up and tell me, or, you know, and I'll be happy to give you a call, answering questions, or you've got my information on the back page there. Call me anytime. If I can't get the answer, I know you can. Okay?
Thank you, Stephanie.
That was good.
Okay, well, good.
Good.
Like I said, my darling David should have been here to do this, but. Yeah, he's home taking care of a very ill wife, so, yeah, that made me sad, but I think he'll be back.
Thank you, Stephanie. That was
Uh-huh.
good.
If I can't use the information, someone in my family,
Yeah.
my sister,
Yeah, have your sister call me.
she lives in Arizona, and she has a condo. And she's always full of these ideas that she wants to leave it to her son, and she, you know, she wouldn't be able to if she did this. But every so often, like her air conditioner goes off and you can't live in Arizona. Or, you know, something goes wrong with her car, and it's a big expense to pull out of her monthly income. So,
I can connect her, I'll just make sure she's with somebody in Arizona who can talk to her. But she needs to make sure she understands this, because there's
Right.
no reason for somebody
having misconceptions.
having misconceptions or running through all their money and living terrified, you know, because.
Right, yeah.
Well, I have such a good